The following selected information is for Okanagan Company for the year ended January 31, 2008. So here is just a list of accounts. And what we need to do is to prepare a multi-step income statement. And this is for a periodic system, since you can see that they have periodic inventory accounts such as freight in and purchases. So that's how you know it's periodic. So to start, we need to write the name of the company, Okanagan Company in this case. And we need to write what kind of statement it is. So in this case, it's a multi-step income statement, but we can just write income statement. And for the third row, we want to write for the year ended and which year did it end. So in the question, it says for the year ended January 31, 2008. So how this is gonna work, there's 4 parts to this. The first part is calculating net sales. And after that is calculating cost of goods sold. And then you do net sales minus cost of goods sold to get gross profit. And then after that, you take a look at your operating expenses. And then you subtract that from the gross profit to get income from operations. And after that, you might have other expenses or other revenue. And then you either get a net positive value or a negative value. And then you can either add that or subtract that from income from operations, and that will give you net income. So let's start with net sales. The first thing you want to do is to write sales revenue. And in this, we're going to have 4 columns. So it's going to be a bit confusing. So sales revenue, that's just sales minus sales returns and allowances and sales discounts. That will give you the net sales. So first we can write sales. And as you can see, it's $315,000. And you can just put that in the 4th column. Next, we got to subtract sales returns and allowances as well as sales discounts. So I'm just going to write less sales returns and allowances. And the number, when you add sales returns and allowances plus sales discounts, is important. So that's why we're going to write it in the 3rd column. And as you can see, it's $13,000. And we're also going to subtract sales discounts, which is $4,000. So as I said, these 2 numbers added together is significant. So I'm going to try to add these together. Which gives you $17,000. And I'm going to underline this to show that we're adding it. Trying to make the line thicker, but for some reason it's not working. Okay, it works. Okay, so now we can get our net sales value, which is sales minus sales returns and allowances minus sales discounts. So essentially 315,000 minus 17,000, and that's going to give the net sales. So that's 298,000. So now we're done the first part. The next part is to calculate the cost of goods sold. So since we're doing a periodic system, the cost of goods sold is calculated when we're doing the income statement, but not in the journal entries. So this is a bit confusing, but let's just write the accounts down first. So to calculate cost of goods sold, you take the beginning inventory, and then the next account is purchases, which is kind of like merchandise inventory in the perpetual system. Okay, let's just write these down first actually. So beginning inventory is the same thing as merchandise inventory beginning, 42,000, and we're gonna write that in the third column. For purchases, that's gonna be over here, so $200,000, and we're gonna write that in the second column. And we need the net purchases. So to do that, we need to less the accounts that will decrease purchases, which are basically purchase returns and allowances and purchase discounts. So I guess it's kind of similar to what we just did above. And the value for purchase returns and allowances is 6,000. Oh my, it's not showing. Anyways, you guys know it's purchase returns and allowances. I'm trying to make this smaller, but I don't know if I can though. That's definitely not it. Anyways, let's move on. After purchase discounts, now we can get our, purchase discounts is 1,000. Now we can get our net purchases. So I'm going to add 6,000 plus 1,000 and write what we got in the second column, which is basically just 7,000. And to get net purchases, that's just 200,000 minus 7,000. Which is 193,000. Let me just underline this to show that we're subtracting it. So the underline could be adding or subtracting. Next, we want to add the freight in. Since freight in is kind of like inventory. So it's kind of like we're adding more inventory, but it's just called freight in. and that's 10,000. And now we can calculate the cost of goods purchased, which is essentially net purchases plus freight in. So that's everything you bought, basically. And we're going to put that in the next column. And the reason why we're doing this is to figure out the cost of goods available for sale. And that's just all the goods that you are able to sell. And to calculate this number, you take the beginning inventory, which is basically the merchandise you already have, and then you add all of the inventory that you purchased, and this number will give you all the goods that are available to be sold. Which is 245,000. Now the next thing we want to do is state the ending inventory. In this case, it tells you it's merchandise inventory ending, which is the same thing as ending inventory, is 61,000. And this is how we calculate the cost of goods sold. You take the cost of goods that are available to be sold, and then you minus the ending inventory. And this number is all the goods that have been sold. It's kind of logical, so you just need to think about it logically. Like if you have all the goods that are available to be sold, and then you have the ending inventory, the difference is the cost of goods that are sold. Which is 184,000. And now we are able to get our gross profit, which is essentially the net sales minus the cost of goods sold. Which is, in this case, 114,000. Now the next step is our operating expenses, and we will have to subtract this from the gross profit to get income from operations. So we can just list out our expenses. We got freight out. Insurance expense. Interest expense is not an operating expense. This goes into other expenses. So next one would be rent expense. Then we've got salaries expense. And that's it. So let's put the values. Freight out is 7,000. We're going to put this in the third column. Insurance expense is 12,000. Rent expense, 20,000. Then salaries expense is 61,000. Yeah. So basically, now we just need to add these all up. To get our total operating expenses which is 100,000, which is a nice number. And the reason why we're doing this is to get our income from operations. And that is our gross profit, the money that we got from subtracting cost of goods sold from cost of goods available for sale. That's our gross profit. And then we need to subtract the income from we need to subtract the total operating expenses to get the income from the operations. 114,000 minus 100,000 is just 14,000. Now we have to go on to other expenses and other revenue. But if you look here, interest expense is the only other expense, and there's no other revenue in here. So we can just skip that and write interest expense. And we don't have to write anything for other revenue. Interest expense is 6,000. And since that's the only number we have, we can just go ahead and put it in the fourth column. So the interest expense is 6,000. And so if we take a look at the question, there is no other expenses or revenue. So that means we can just calculate net income. By subtracting the interest expense from income from operations. So 14,000 minus 6,000, that's 8,000. And we can double underline this. Since it's the net income. So that is it for Okanagan Company. The following is an alphabetical list of Tessie's Tater Tots adjusted account balances at the end of the company's fiscal year on December 31, 2008. So we're just going to do part B and just prepare a multi-step income statement. So again, we're going to start with the company name. In this case, not sure how to pronounce it, but Tessie's Tater Tots. Second row is what it is, which is an income statement. Third row is for the year ending, and in the question it says adjusted account balances at the end of the company's fiscal year on December 31, 2008. So that means the year ending is December 31, 2008. So let's start with sales revenue. Sales revenues. First thing we want is sales. And that is 623,000, and that goes in the fourth column. Next, we want to subtract some accounts, namely sales, returns, and allowances. And we also want to subtract sales discounts. This goes in the third column. Sales returns and allowances is $8,000. And sales discounts is $6,200. And we need to add the sales returns and allowances with the sales discounts. And that's going to give us 14,200. And the next account is going to be net sales, which is just all the sales that we have. And to get this number, we're going to take sales revenue and subtract this number that we got here, which is the total of sales returns and allowances and sales discounts. And this gives you the net sales. So a line underneath that could mean either addition or subtraction. Now the next part is calculating cost of goods sold. Cost of goods sold. The first account is beginning inventory. And let's try to find it in the question. Here it is. Inventory January 1st, 2008. That's the same thing as beginning inventory, and that's 40,500. And this goes in the third column. Next, we have purchases. Which is kind of like the merchandise inventory. And in this question, there's 441,600. And this goes in the second column because we need to subtract the purchase returns and allowances as well as the purchase discounts to get the net purchases. So here we are subtracting purchase returns and allowances as well as purchase discounts. And this goes in the first column. So purchase returns and allowances is 6,400 and purchase discounts is 4,450. So next we have to add these together. Let's just add a line to show that we added them. And now we can get our net purchases. Which is just our purchases minus purchase returns and allowances and purchase discounts. So as you can see, it's kind of similar to net sales, except this time it's with net purchases. So I'm taking purchases minus purchase returns and allowances minus purchase discounts. which gives us net purchases. Now, the last step to getting the inventory value is to add the freight in, because freight in, it's kind of like merchandise inventory. And it's 5,600. And once we add this, we'll get our cost of goods purchased. So it's basically all the merchandise inventory that we have purchased. And this makes sense since we're adding the net purchases and freight in, which is basically kind of merchandise inventory. And we're going to put this in the third column, since after this we're going to calculate cost of goods available for sale. So what I'm doing now is adding the net purchases and the freight in. So now we can calculate the cost of goods available for sale. And that's going to be the beginning inventory plus the cost of goods purchased, because this represents everything that we have that is available to be sold. Now we need to find the value of ending inventory. And as you can see in the question, it doesn't tell you, but in the additional facts, it says a merchandise inventory on December 31, 2008 is 72,600. So that is a value of the ending inventory, 72,600. And we got our cost of goods sold. Which is our cost of goods that are available to be sold minus the ending inventory. So this will give you the cost of goods that you actually sold. And then we can calculate our gross profit. Actually, I'm going to put this in the fourth column. Because for gross profit, you want the net sales minus the cost of goods sold. The next step is operating expenses. Let's see what kind of expenses we have. So we have amortization expense, 23,400. We're going to put this in the third column. We got insurance expense, 7,200. Interest expense, interest revenue, those are not operating expenses. These are other expenses and revenue. But property tax expense, that goes under operating expenses, and it's 4,800. And then we've got salaries expense, which is 122,500. Next, supplies expense, and then utilities expense. Supplies expense is 2,000. And utilities expense is 18,000. Now we can add these all up to find the total expenses. Which is 177,900, and we want this number so that we can get the income from operations. And this is the gross profit minus the operating expenses. Which is 26,650. Now we can take a look at other expenses. So all we've got really is interest expense for other expenses, which is 5,400. And this time we're going to put it in the third column because we also have other revenue, which is 1,050 for interest revenue. Yeah, 1,050. So what we want to do is to do revenue minus expenses. So actually, maybe it would be more useful to put other revenue first, but personally, I don't think it matters that much as long as you have both of these on here. So we've got to do the interest revenue, 1,050, minus the interest expense, which turns out to be a negative number. For negative 4,350. So this number is what we're going to subtract from income from operations. If this number was positive, then we would add it to income from operations. We just want to know what's how interest revenue and interest expense is going to affect the income from operations. So this gives you a net income. We've got the income from our operations, and this is the total number that we got from subtracting expense from revenue for the other expenses and revenues. So all we gotta do is 26,650 minus 4,350. And we get 22,300. And that is our net income. So this is it for this question.